Master your money, free your future. Welcome to Budget for Life. My name is Jeremy, and I just want to say welcome to any or all of my new subscribers. Thank you so much for being a part of the channel. And I just want to say thank you to Marantz for putting my video out there on why GameStop is officially in the end game. A little bit about me, just super briefly. I am a finance bro, as you said, Marantz. So I own an investment management firm. I manage money for clients. I also have a budget software. It's a paid software that's called Budget for Life. That's what I named this channel after, but really this channel is just an expression of my thoughts, just a day in the dome of Jeremy as an investment manager, an investment analyst, and really a guy who loves to make spreadsheets and crunch numbers. There's a little bit of faith, a little bit of family in there as well. I'm married for 10 years now, I have two kids and a third on the way. So I used to be a pastor. There's a lot of kind of side plots going on, but as it relates to this channel, I have been reflecting a little bit on really a big part of my investment uh, journey, I guess you could say. And really specifically, I think about 2018, 2019 were years in particular where I was following a lot of the information from Galley from Hyperchange and what's his name? Rob from Tesla Daily. Two guys that were covering Tesla in depth, like that knew the company back and forth. And it helped me become an early Tesla investor to go through their content, see their relatively sound mind, relatively level head, not just we're going to the moon, not just we're going to burn shorts, but really how can we look at the numbers and rationalize them? And they were doing a really great job communicating how the numbers didn't make any sense at that point in 2019, June 2019, you could buy a share of Tesla for the same thing you could buy it for in 2013. Before the Model 3 even existed, before they even made the Model S and X, and at this point they were ramping the Model 3, EVs were really beginning to grow and yet mainstream media, all the articles out there were talking about just FUD, fear, uncertainty, and doubt, honestly, lies, a lot of them factually incorrect, reporting on Tesla that just started to be fuel to the fire to the Tesla investor community online to say, man, we got to just present the truth. Because even if this company is not everything we want it to be, even if it doesn't grow into the best case scenario, it's not being accurately described from just a current and backwards looking scenario. What has the company already done? Where is it at right now? We should all be able to agree on the facts of that, and then we can debate on what does the future hold. But at that time in Tesla discourse, there was really no public appreciation for what had Tesla already accomplished and where were they in the present. A little bit of a long preamble here, but at this point, I feel pretty comfortable that, well, I'm just kind of curious. I'm kind of comfortable, kind of curious. I'm kind of warming up to the thought of what if I were a galley? What galley meant to Tesla, what Tesla Daily meant to Tesla. What if I could offer something similar to GameStop, at least in the short run? Galley doesn't talk about Tesla every day anymore. Tesla Daily is no longer daily, right? But there was this period of time in that 2018, 19, 2020, even 21 window where so much was happening so fast. The stock price was changing so fast that it was hard to catch up if you weren't a 2013 early investor in Tesla, right? If you were just trying to get up to speed and say, how do I make sense of all these numbers? It was awesome to have an expert analyst be able to share perspective and honestly even share perspective on when it was getting a little bit overheated towards the end of their short squeeze. And so I want to make videos continuing to deep dive into really the fundamental status of GameStop, maybe some things that you might not be seeing or thinking about from their financials, their reported numbers, as well as a little bit of what's in store for the company, what's coming ahead, as well as one thought I had is, I would really like to read through occasionally some, financial news, right? Some reporting that's going on in the company and just kind of break down the article and say like, okay, is what this article is saying true? And then there's going to be some things that are opinion based, right? It's like, well, you're entitled to that opinion. And we could debate those aspects as well, those angles, but at the very least, is the presentation, factually consistent? And I think what we're going to find is that in a lot of ways, GameStop's in a similar place to where Tesla was back in 2019, when there had just become such a disconnect from really the fundamental performance of the company and the financial performance of the company compared to the coverage and the kind of mainstream media, the financial media coverage of the company. And I just want to say thank you to those who helped bridge that gap for me because I made a lot of money. I mean, I made several $100,000 because I was an early Tesla investor who started investing in Tesla in the summer of 2019, which is I mean, it's a joke to consider that early compared to the development of the company, but it was just early enough to be considered early from the stock price appreciation that was to come. And I feel like there are some similarities with GameStop where, for several years now, there's been the true early investors. And now we're at this point where the stock price hasn't moved at all. You can buy it for the same price now you could buy it for 4 years ago, 5 years ago, in terms of a share of GameStop. And yet the financial status of the company and the fundamental performance of the company is so drastically different than where it was then that I kind of feel not quite a sense of obligation, but it feels a little bit potentially fulfilling, potentially rewarding to get to be a galley for some people out there on the internet, right? To help uh, bring my analysis, bring my perspective, my, somewhat level of expertise at this point on this particular company and, just help bridge that gap. Let's just get the narrative consistent with reality and let's let the debate be on what's unknown, but let's stop debating the things that are already known and let's start treating this company fairly, right? So, all that to say, long preamble, I'm going to be talking about GameStop a lot on this channel. Also, there's a little bit of two birds with one stone for me because, like I said, I am an investment manager. I manage assets for clients, and GameStop right now is by far the largest position in my client portfolios. Not financial advice, but um, making these videos is like maybe helpful for me to be able to potentially send some of you, if any clients are watching this, to send some of you guys to, hey, what am I seeing here or there? A video I'm going to make soon is what's the downside risk of GameStop? What's the key man risk of GameStop? I want to talk about what's the upside scenario fundamentally, what's the upside scenario from a technical perspective, and then I want to keep diving into the nuts and bolts of their financials and help you guys see what maybe you don't already see. So, in this video, I want to kind of respond to Morantz because he shared two things that were awesome. Um, let me jump back into my spreadsheet here. And first, again, just thank you, Morantz. 14,000 plus subscribers covering my video. I really appreciate that a lot. Um, because now over on, Budget for Life,
Master
we're
your
at
money.
910. We're almost at 1,000 subs. So hey, you can be an early sub. Maybe you can't be an early investor because there's no money to be made on my YouTube channel. No Discord. I don't have any courses for sale. I'm a normal guy. Okay, I'm really a normal guy making these videos for personal fulfillment more than anything. But also I'm an external processor, so maybe it's good for me to be thinking about this stuff. But thank you guys to those who have jumped in. Two things Morant said. One, he said, I talk slow and you might want to watch my videos on 1.5 speed. And I just want to say that's why they make it. That is why they make 1.5 speed. So I'm not going to talk super fast. I want to, first of all, I can't, okay? I'm 31. This is how fast I talk. All right. But also, I don't want to be spewing information so quickly. This is not like a dopamine boom channel. This is not, I don't edit my videos. I don't really do thumbnails. I don't hire work, at least right now. One day, if I had a bazillion dollars, maybe I'd put a little more work into the production value and, the engagement quality and entertainment quality. But right now, this is old school YouTube where when someone said something, that someone was actually going by their own name, which my name is Jeremy BR. You can look me up. And that what they were saying was actually that person's held opinion. Like this is just a guy having a conversation. All that to say, you can watch on 1.5 speed. It's not going to offend me, but I'm going to keep talking my pace because that's how I know how to do it. And I also do want to appeal to an audience that maybe doesn't already know everything about GameStop or about whatever it is that I'm talking about, and I want to talk slowly enough to where, hey, you can pause the video, you can think about something, look at something that I'm talking about, and not feel like, whoa, whoa, so much information. Whoa, 20 minutes later, boom, video's over. Oh my gosh, this is amazing. And then you just look for the next video that makes you feel that way, but you're never actually digesting information. I'm trying to actually teach and educate a little bit over here. But who knows? I might get a little bit entertaining. Maybe one day I'll think of a joke. No promises. So, the other thing that Morant said was a disbelief in my projection of GameStop's store count. So, I want to talk about this because it got me curious. Like, man, how can we best estimate GameStop's store count? And I went to, the very back 2018 and early and really since then, trying to calculate like what how do we know how many stores they have? Because they only tell you in the 10Ks, they only tell you once a year what their store count is. So in row 66, like this is their actual store count when these are being filed. We don't find out about it until, April, but it's based on February 1st of that following calendar year. So February 1st of 2021 is technically what this number is coming from. But they ended the full year 2020 with 4,816 stores. So we know that factually. We also know these numbers here in this column. So on their 10Ks, they have a right to use asset. And what I'm doing here is just dividing that by the total number of leases. So in their 2020 10K, they had 662.1 million. So I'm just putting this in millions terms with that multiplication there, divided by the total stores. And it's saying, okay, so that asset value is 137,000 per lease contract. And then you have corresponding liabilities. A portion of it is current. So this current liability, 227.4 million, that's how much GameStop expects to pay in the coming 12 months in rent. And then you have the long-term portion, 456.7, and you'll see there's a little bit of a discrepancy. If you sum these together, it's 142,000 compared to the 137,000. My guess is this has something to do with, the current, you know, the rent payments that have already been paid, like in the like coming weeks or whatever. But like the super nearest term uh, lease payments that are still technically a liability because that you're under that period, but it's no longer an asset because you've already paid. Maybe like you paid it for the coming month or something like that. So that 1 month is already off the books. Regardless, track with me here on the asset value because if you kind of go forward in time, you'll see that the value per lease has a little bit of variance. 137,000 to 128 to 127, back up to 133, but full year 2024 all the way down to 116. And so the value per lease is not really the best. What I learned, honestly, through deep diving into this, thanks to you, Marantz, was just basing off the asset value is not the most reliable figure because there's a decent level of variance in that number. But here's what's super interesting. The current portion is way more stable. Check this out. So in 2020, the amount that GameStop expected to pay over the coming 12 months in rent was $47,000 per lease. That went down to 46, all the way down to 44. So you can see they're bringing that number down. But in full year 2023, it was 45K. And in full year 2024, it was 45K. So you're seeing this stabilize out even as their total leases is all the way down to 3203 at the end of 2024 compared to, 4816 at the end of 2020. So, why does that matter? Because every quarter we do get the updated number for the current portion of your lease liability. Okay? So we have that number every quarter. For the Q1 of 2021, it was 219.4 million. For Q2, it was 221.5. Q3 it was 211.9, etc. What I'm doing in this row 44 is I'm just punching in numbers in the denominator again and again to solve for what is the store number that would get me the closest to the current liability per lease figure reported on their most recent 10K. So you'll see these numbers are basically the same for all 4 quarters. So if we didn't have 2021 and beyond data, if we didn't know that that data existed, then if we were back in 2021 real time, the best we would have to go off of is okay, their current liabilities are going to be about 47K. So as their current liabilities are going down, the corresponding denominator also must go down proportionally. And so you'll see that these are all in gray because they're my projections, right? But on an estimated basis, their active store count based on their previous year's current liability per lease value, if you were to take that figure and make that the variable by which you solve for current store count, you would have gotten a number that by the end of the year would have told you that they had 4,462 stores. In reality, they reported that they had 4,573. So that margin of difference is 2.43%. And the reason for that discrepancy is because what we learned at the end of 2021 is, oh, their current liability per lease actually went down to 46,000, right? So if we had hypothetically, if we had known that in advance, which we don't ever know stuff in advance, we could have solved for, this 46,000 number on these columns and it would have given us a even more accurate projection of what's their total store count. But the point is, in 2021, estimating the current store count was accurate with a 2.43% error. Are you tracking with me? And what's exciting is that this gets more accurate. In the next year, there's a little bit more variance because that dip is another $2,000 per lease. The liability per lease, 46K in 2021, 44K in 2022. So your estimated current store count ended up being a 4.24% error. But all things considered, when you're projecting numbers or trying to solve for numbers that you don't know based on figures within the 10K, a 4% margin of error, one way or the other, you'll live with that. And here's where it stabilizes because it seems that 45 is really the mean. You had 47, 46, 44, 45, 45. So in 2023, again, a 2% error. In 2024, a 0.06% error. Estimating based on their current lease liability what their current store count is. And that is with a year that they closed 966 stores. So even a huge reduction, almost greater than 20% basically deduction in store count, still you're able to see that happen, not quite real time, but you're able to see that happen on a quarterly basis because you are getting that updated liability figure. And so in Q1 and Q2 of 2025, you have this updated liability figure. In Q1, the liability is all the way down to $113.3 million dollars. And in Q2, it's $101.5 million dollars. The current portion of the lease liability. 101, which where were we in Q2 of 2021? 221.5. That's crazy. That's like a 60% drop. That's just beautiful. So all that to say, when I gave my store count figure, Marantz, you said like, oh, 22, I don't know about that, which I actually had it at, I think at 2140 in that last video, because I was basing it off of the asset value, but the liability value actually gives you a lot closer estimate. So I came up 100 stores for you, Marantz. But Marantz like, I'll meet you at 26. And I'm saying it's not 26. I'm saying their current store count is closer to 22. Why does this matter? And then I'll wrap up the video for today. The store count going down matters for a handful of reasons. In no particular order, the most obvious one is that it saves them substantially on their SG&A. Let me I wonder if I can show you. Yeah, so SG&A listed here in their most recent 10Q, $184.6 million dollars of the $218 million dollars of SG&A were store related. So when you see the breakdown in the income statement, you have net sales and then cost of sales. The cost of sales is like what the cost of the inventory. It's not, and the SG&A is like what did it like what's the overhead? Right? What's the cost of the operations of the sales? And so what you see here is, $34 million dollars is really all it costs GameStop to pay home base, to pay corporate GameStop. all the rest of this SG&A is store-related SG&A. So when you're seeing this store count figure come down aggressively, it means that their forward-looking SG&A is also coming down because you have, a portion that's already realized because you're already down to 218. But a portion of it is going to be realized in the coming months because there are costs associated with closing stores. And so you'll see a bigger portion of the profit impact when those stores are already fully closed and you see that hit each quarter compared to, well, the store was still open for part of the quarter and also we had to pay some money to close the store during the quarter. And so you're going to see the impact of store closures continue to drag down SG&A in which is great. Every dollar you save on SG&A is another dollar that you make in operating income, which is another dollar that you make in net income. So you're cutting costs, increasing profitability. That's the most obvious benefit of the store closures. Another benefit is that you're substantially lowering downside risk. Every the more money that it takes, the more money that it costs you, the more money that's required for you to make your money, the more downside risk you have. Because what if something goes wrong with the operation? If GameStop can make, $1 billion in sales each quarter with only $100 million of SG&A, that is an order of magnitude change in terms of, well, what if something goes wrong, or what if sales goes down, or how does that impact the business? The smaller your footprint, the easier it is to correct things, and honestly, the less meaningful, um, like the less, I don't know, I don't know how to say exactly what I'm trying to say there. Let me move on to the third point, which is probably the most important point. The fewer stores that GameStop has, while simultaneously sales remains either unchanged or growing, as we'll continue, as we've seen here now, and we'll see continuing quarter over quarter for probably many years to come. What that means is not necessarily that every GameStop store left is just some superstore. What it means is a higher and higher percentage of GameStop customers are shopping online at GameStop. A higher percentage of their revenue is coming from e-commerce. And that is meaningful again because that means there's even more stores they could close, which is even more money they could save, right? But it also matters when you're talking about the market value of the company because now you're talking about a retailer that should compete more with online retailers as far as their valuations go and not be considered as much with super brick and mortar fixated companies. So we like seeing store count go down. Obviously, you don't want anyone to lose their job. That's not the part that we're excited about. But as it relates to righting the ship within the company to then prepare for continued expansion, the less overhead you have, the more efficient you are, the more profitable you are. The more profitable you are, particularly as a percentage of your sales, the more appealing you are from a valuation perspective, and the higher percentage of your sales that come from e-commerce, the more appealing you are from a valuation perspective. And the lower your overhead, the lower your downside risk, the lower your cost of operations. And so the more storms you can weather without needing to worry. SG&A currently, as a percent of sales, 22.51%. So there's been a ton of coverage about GameStop's sales figure coming down over the years, right? They bottomed out last year at 3.8 billion in sales on a 12-month basis compared to 8.3 billion in 2018. But get this, their SG&A as a percentage of sales was higher even when they were making more than double in revenue. They were making more than double in revenue in 2018 what they're making on a trailing 12-month basis currently, and yet their SG&A as a percentage of sales is lower now than it was then. To put it differently, GameStop is at all-time highs as it relates to efficiency. They're at all-time high efficiency, and the trend is, as we can see with the store closures, that they are going to get even more efficient even still, and that their sales are on pace to continue to grow. So if costs are coming down and sales are going up, that means SG&A as a percentage of sales is going to look even more dramatically impressive, particularly as you're going into Q3 and Q4. You're going to obviously see sales ramp up as it relates to that. A lot of GameStop's uh, earnings always come in Q3 and Q4. 40% of their revenue generally is generated in Q4, and that's just in a historical basis. But now we have Power Packs coming online, and of course we have the Switch 2 and the related Switch 2 video games. And then you have the Xbox handheld that I think might be coming out by Q4 as well. And so there's a lot of revenue boosts just coming on the horizon, not to mention Lego coming to GameStop stores. And in 2026, Pokemon and Lego officially begin a collaboration. So sales going up while still stores are closing, still SG&A is going down. It's going to do impressive things as it relates to SG&A as a percentage of sales, which is really just a way to illustrate how efficiently is this company operating. And GameStop, it is operating very efficiently. So, let me know if you learn anything in this video. Let me know if you have a different way of estimating the current store count of GameStop. But I'm here to tell you that GameStop has closed 1,000 stores already in 2025. Now, 500 of those stores are related to Canada selling, and Europe, France hasn't sold yet, but they've already taken those lease obligations, those France leases, off of that line item, and they've moved them to a different line item called liabilities held for sale, assets held for sale. So 500 of those 1,000 stores we know for sure are off the books, but that's another 500 stores between Australia and the US, approximately, that GameStop has closed in 2025. That is great news as it relates to the profitability, the efficiency, and ultimately the price multiple that GameStop demands. That's all I got for y'all on this one. I'll talk to y'all soon.